We might get started, just so we can stick to time. I'd like to welcome everyone today to this panel on climate change risk and the changing insurance landscape. My name is Erin Laurie and I'm from the Department of Environment, Land, Water and Planning in Victoria in the Adaptation Policy team. This panel today is sponsored by the Victorian Government and it delivers on a commitment we've made under the Victorian Climate Change Adaptation Plan to deliver a discussion forum on the insurance issues associated with climate change. Our chair today is Ian Edwards, and I'd like to say a very sincere thank you for helping me put this panel together. It's been very helpful. Ian is a climate change adaptation analyst. He's a chartered accountant with 20 years experience in national and international financial services. He has worked across a broad spectrum of the financial industry, including public practice, investment banking and reinsurance. His career has focused predominantly on affecting system change at a multinational scale. Ian has led worked on climate change adaptation projects both within Australia and internationally. Amongst other things, Ian's research has explored the viability of risk transfer mechanisms, such as insurance, in the face of climate risk for local government. Thank you, Ian.
Thanks, Erin, and welcome everyone to climate change risk and the changing insurance landscape. I'd just like to start with thanking Erin and Alice from the Victorian Government for giving us this opportunity to talk about this issue, which is obviously a big issue by the number of sessions we've had so far today on insurance and the finance industry in general. And I hope with the format, and I think with the format of what we're going to do today, I think we'll be looking at insurance from a slightly different angle from what we've spoken about so far, which might give people another way to think about the mechanism and the industry itself. But actually, before I start, I would like to show my respects and acknowledge the traditional custodians of the land, the Wurundjeri people, of elders past and present, from which this meeting takes place. So listen, what we thought we'd do today, and I'm sort of glad we're doing it this way because it really is getting towards death by PowerPoint. I've got a set of slides, and that's it. But beyond that, we're really just going to have an informal discussion around climate change and the changing insurance industry. So, it's not right, where'd it come from? Oh, hold on, I've got to click on this thing, don't I? Is that right? Yeah, there we go. There we go. Right, so this is the format we're sort of looking at. What I'd like to do is, there's been a lot of discussion around insurance today, but really, we're not all insurers in the room, and I'd like to take it back a little bit. And I don't want to sound derogatory because that's not what I mean, but I've sort of put a number of slides together around a guide to insurance for a 9-year-old. And I ran it past my 9-year-old, and he sort of got it. Animation and stuff like that, you love that. So just to sort of set the scene around insurance, the insurance industry, and what it means for its relationship with climate change and natural catastrophe risk. I'm then going to hand it over to the panellists, and they're going to introduce themselves. So they're going to let you know who they are, where they're from, and what their experience is. And then we're going to open it up to a panel discussion. I think in the first instance, we'll see how we go. There's a bit of a risk with this. It could go very, very quiet, very, very quickly, in which case I'll open it up to the audience. But I think in the first instance, we'll just stick to the panel, and at a minimum of 20 minutes to go, I'll open it up to the audience for questions. So if anything burning, if you pick something up, just write it down or keep note of it, and we can talk about it later. So these are the themes we'd like to explore. You know, we're talking about the implications of climate change for the insurance industry, and there's certainly a massive wealth of information in the academic literature about that. It'd be nice to explore what it really means on the ground. What does this mean for the insured? So for the policyholders out there, what are the implications of climate change via insurance for those people who use that mechanism as part of their risk transfer policy? What is required to ensure affordable insurance going forward and ensuring that it's actually available to people or to corporations or to governments or whoever? What collaboration exists or collaboration opportunities exist to actually ensure that insurance is available and affordable going forward? And then also, you know, let's talk about insurance and actually the limits of insurance, where it really fits in the bigger picture. So that's the sort of things we're looking at discussing today. So anyway, let's sort of kick right into it. And forgive me if I'm sort of teaching people to suck egg, but sometimes it's just good to step back to step forward. So what is insurance? Well, it's a mechanism that provides financial compensation in the event of damages suffered due to unforeseen circumstances. Now, a lot of the insurance that's being spoken about today is actually general insurance. We tend to sort of differentiate between general insurance and life insurance. Now, you could say that life or death is definitely not an unforeseen circumstance, but perhaps where that definition fits there is actually the timing of death. So how does it work? Well, consumers pay a small regular amount or a premium pursuant to a contractual agreement or a policy in return for that protection. And that protection is essentially, it's a form of risk transferal. So you're transferring the risk of the impact of a particular event from yourself to an insurer who assumes that risk. It's pretty simply how it all comes together. I'm just hoping these guys don't disagree this evening. Now, I mean, this is a little diagram I put together, and all these little dots, and we've got these two axes. So we've got the geographical axis, which is the y-axis. That's essentially just space and place, and also entities and people. As you can see, it's all spread out all over the place. There's also a time axis, and that can relate to the premiums that are paid themselves, but they're paid over differing points in time. So what you're getting is a distribution of people and premiums paid at different points in time. And what the insurance industry does, very, very basically, is it accumulates all of these policies, these monies, and if one of these poor buggers gets affected in one way or another, then it makes good on those particular damages. Right? So that's really the guts of it. There's a couple of things that are required. One, it relies on low correlation. So as you can see, this event has impacted this poor particular individual over here, but everyone else is okay. So there's low correlation. An important but not always practical aspect is actuarial fairness. So in other words, the risk of that event is actually incorporated in the premium price. And the other thing is just actually having the ability to calculate the risk in the first place is really, really important to insurance. So just quickly talking about the insurance landscape. So we have the policyholder. The policyholder takes out a contract with the direct insurer. The direct insurer then accumulates all of this risk. It may decide, for various reasons, like the capital requirements, maybe a risk appetite, for example, all sorts of reasons, that they will then transfer some of that risk to a reinsurer. So a reinsurer, if you like, is an insurer of an insurance company. And then it doesn't stop there, because the reinsurer then may retrocede to further reinsurers. In this way, it spreads the risk out right across the whole insurance industry. And there's other players. We've got brokers. So brokers are the entities that can create these relationships at each of these intersections the whole way through this particular process, if you like. And they also provide services. Now, there's one other thing that's probably worth quickly just talking about, and that is this third party. This has started to evolve since about the 1990s. So these are things like catastrophe bonds and insurance-linked securities. So instead of the insurers actually assuming the risk, it's actually going out to the market. So the market is assuming the risk. So this is another important player that's actually starting to or has already started to evolve and is available around risk transference out there. And just quickly, just one more little bit thing here. These yellow dots, these are all insurers, direct insurers. Here we've got a reinsurer, I think probably sitting in Cuba. It wasn't meant to be Cuba, it's in the Bahamas somewhere. And the thing about the direct insurers is that they tend, and this is not always the case, but they will tend to have a local focus. So they're assuming risk from a local perspective or a country perspective. But what they will do is they will transfer that risk to a reinsurer who will have a much more global view, much broader view of risk. Yeah. Now, just quickly, just talking about natural catastrophes, I'm almost there. Natural catastrophes in respect to other forms of insurance comes with particular challenges. And there's a good reason I'll raise this, and I think the guys will talk about this later. And that is really, they tend to be a lot more volatile. We can go forever without a drought. It's only wham, we're into the millennium drought. And the magnitude can be much, much larger and much broader than other types of insurance, if you like. Now that has ramifications. It means that because you don't know when the event is going to hit, and because it's going to be big, it means you may have to hold larger capital reserves. And those capital reserves are the monies you put away for the rainy day to meet those losses. So you're holding higher capital reserves. It also incorporates or potentially incorporates ambiguity. Because of the volatility, you can calculate the risk, but the confidence in the risk, depending on the confidence in the risk, will determine how ambiguous that risk is. And if you're not that confident, you're probably pricing a little bit more to sort of allow for that higher end scenario, if you like. And then, of course, there's a greater emphasis on transferring risk. So, bigger hit, more volatile, you may not want to hold it, therefore as a direct insurer, you may transfer it to a reinsurer and so on and so forth from there. Now that has implications, and that really is affordability, and that's where I'm getting at with this. None of these things come for free. Holding capital reserves cost money because you're not using the finance efficiently, and biggest risk, as I mentioned, transferring risk, you have to pay to do that. And that can impact affordability, which can actually impact a consumer's willingness or ability to actually pay and actually engage in insurance in the first place. Now, what I raise that, if I go back to my little diagram, with climate change, what we have is we potentially have much, much bigger events. We also potentially have more frequent events. Or we might get them both together. We don't really know. And what that means is we potentially have higher magnitude, we can potentially have higher frequency, which increases the volatility, which increases the risk, which makes it so much harder to calculate. Is this okay with you? Which pushes the price up, which has a negative impact on affordability. So this really is just setting the scene for the discussion today. So I'd just like to, at that point, just hand over to the panel. Kate, would you want just kicking off and letting us know?
I don't know. Can anyone hear me? Okay, so I think that Ian sort of alluded to this, but so I'm from Willis-Reed, which if you got coffee today, I'm hoping that you recognise the name of. And so slightly confusingly, Willis-Reed is actually not a reinsurer, we're a reinsurance broker.
Could you maybe stand at the podium? It's actually hard for us to see you back here. Is that
I can do it this bit, it might be a bit confusing later.
Yeah, you can come in closer.
Oh no, it's just because you're at the same level as us.
Yeah, I'll just stand up for a moment.
Oh, that's good.
Okay, so as I was saying, Willis-Reed is actually a reinsurance broker, so we negotiate deals between insurers and reinsurers. Within that, the function that I serve is I'm part of the catastrophe analytics team. So we make natural hazard models, which basically tell insurers which of their portfolio is at risk to particular natural perils. And I think that there was an introduction to sort of general insurance versus life. We really just look at property with a little bit of motor. So I guess an example of this will be, for example, like a flood model, which if anyone was my talk earlier, I sort of explained, and we look at average return interval floods, so 20, 50, 100 years. And now what we need to consider is, will these average return intervals change with a climate change risk? And just to round off, I suppose it's something I'm interested in because my background is in physical climate science.
Thanks, Kate. I might get up. So my name's Joel Pridmore. I work for Munich Re, which, depending on the forex exchange, the Swiss franc and the euro is the largest reinsurance company in the world. Ourselves at Swiss Re. I'm in an interesting space in the group because I'm actually part of our Lloyd's syndicate. So most of you have heard of Lloyd's of London. Munich Re own a Lloyd's syndicate. So the benefit of that is that I'm part of a wider reinsurance group that actually focused on the direct market. Inevitably in Asia, where I'm based, we do a lot of reinsurance transactions as well. Further, I'm also part of our Asia Pacific corporate responsibility representative. So that means that I get access to our global chief economist and his corporate responsibility team. So a lot of our work in that regard is around modelling, around climate change, analytics, and things like that. I guess the benefit of having Munich Re as a presentation like this is there's probably no company in the world right now with more skin in the game on this topic. Inevitably, anything that goes wrong, natural catastrophe-wise in the world, we're inevitably picking up the bill at some point. So we do take this topic very seriously, and the research we do is incredible. And I encourage all of you, if you're interested, to get in touch with me or Ian, and I can direct you to those sources. So my background originally, still is financial lines, so that's a lot of liability classes, so directors and officers, professional indemnity and crime. But as I say, I've got more of a broader role now, which includes structured solutions, and a lot of that is around, how do we get ahead of the curve in regards to climate change initiatives, things like derivatives around weather events, mine rehabilitation solutions as well, so to help new industries develop in that regard. So I guess the overarching message is that we're an organisation, committed to not only our shareholders and customers, but also this topic in general. So I'll hand over to Sharanjit.
What do you reckon? You're going to go up there as well? Hi, so my name is Sharanjit Padam. I'm an actuary by trade, so I fundamentally calculate financial risk. I'm a consulting actuary. I work at Deloitte. And I've kind of stumbled into working in the climate change arena. It's a long story. Buy me a drink later and I'll tell you why I'm working in this space. But this is my first time at NCARF, and I finally found, I think, the words that describe what I do for a living. And that is I help insurers, banks and investors adapt to climate change as an issue. So I help them understand what they need to do to change in terms of their products, their strategy, the capabilities they need, how it affects their risk management, how it affects their capital needs, how it might change their pricing. And I advise insurers on that basis, and I also do the same for banks. So yeah, that's my background.
This is a jump over the table. Hello everyone, my name is Gabby Fennessy. I work for the Victorian Managed Insurance Authority. VMIA was set up in 1986, through legislation of the Victorian Parliament. So we are the state's insurer and risk manager. We're what you would call a captive insurer. That means we were set up by government so that government entities didn't have to purchase insurance on the commercial markets. There's a lot of advantages in being a captive insurer. One is that you can actually access the reinsurance markets directly. You can offer insurance products where the commercial market can't. We'll probably talk about some of those. An example would be roads. We insure roads and Vic roads. So that's quite an interesting activity. We're also legislated to be risk managers for the state. That's fairly unusual. No other state in Australia has that specific role coupled with insurance. So we spend a lot of our time and efforts on providing risk management. So we'll talk a bit about that later. I suppose also we reduce cost for government agencies because we have economies of scale. We have over 4,300 clients. They can be as big as some of the major departments. They could be authorities, law courts, down to schools, kindergartens, hospitals. So we have a broad range of clients and a broad range of products. One of the biggest ones obviously is property insurance. We do directors and officers insurance, public liability insurance, cyber insurance. We are, I suppose, growing and growing, especially in areas such as cyber insurance. We also self-insure for health in Victoria, so that's our biggest area of exposure is in hospital land. So pretty interesting role in the state of Victoria. We have a view of advising also the whole of government. What are those issues that cut across all agencies and all departments? We have quite good joined-up intelligence and thinking about how topics and issues can actually affect all departments and how interagency risk might operate in that environment. So quite a bit of sophisticated thinking and advice that we give, and we work at lots of different levels in government. Thanks.
I'm not too sure how this is going to work if we're going to set up here every single time. So are you guys okay if we use the microphone going? Yep. Does that work for people?
Yep.
Because what I wanted to do was I just wanted to quickly go back, because I don't want to leave you with those explosions. And I thought I would go back if I could get there. Actually, let's stick with this. So what we've got on our panel is essentially a captive to an extent is direct insurance. We've got a direct insurer, we've got a reinsurer, we've got a broker, and we've just got a guru who's done everything. So we've got a really, really good panel here. So, you know, we want to go the right way. Oh yeah, we've got someone with, well, certainly experienced with third-party products. So if I just head back again, back over here to the theme, just to remind ourselves of this is what we're talking about. Now, the thing I should have mentioned also with the themes is this is not necessarily it. This is just what we've sort of discussed, that we've discussed today. But of course, if there's anything else out there that comes up that you'd like to discuss, I think it's fair to say just ask the question. You know? So, like, stepping straight into that, I'm actually going to kick off the discussion. Is that okay? Yeah. And I'm going to... One of the things when I was talking about affordability, and if you take that to the nth degree, and there's certainly, as I mentioned before, there's a mountain of academic literature out around this by the likes of Evan Mills, Kunrutha, I think it's Suarez, all these individuals, that, you know, a business exists to expand its market share, not shrink it. So as insurance becomes less affordable, then the market starts to shrink, and ultimately climate change potentially does, this is a theory, once again I'd like to explore it, is a risk to the industry itself. And this is encapsulated, I've got a quote here from the Geneva Association back in 2014. Geneva Association is an association of insurers, I think the maximum 90, back then it was 66. Munich Re is a part of the Geneva Association, sits on the board. And what they stated was the prospect of extreme climate change and its potentially devastating economic and social consequences are of great concern to the insurance industry. And I'd like to just kick this off. I'm going to pose this directly to Joel, for these from Munich Re. I'd just like to say, Joel, is there any truth in that?
Well, I think, and I'll speak from my own personal point of view and not the group's, because I'll probably get in trouble somewhere. I think there is, absolutely. I think that there's always a view that the insurance industry always makes money, number one, but there's always something to insure, number two. I'll give you some stats last year just from Lloyd's as a general corporation. The results for 2017 for Lloyd's were a combined operating ratio of 114 or 115%, which means that the whole Lloyd's market is losing 15 cents on every dollar of premium that they write. And a lot of that is related to those natural catastrophes in the Gulf of Mexico, last hurricane season. The more worrying thing for the insurance industry is that we can generally budget those nat cats generally, but there's also an attritional problem with rising attritional losses as well. So as Ian put up on his diagram, before, where you've got that combination and the perfect storm of attritional plus nat cat, you've got a real problem. And I'd say that this industry does have a real problem right now. Hence why we're putting a lot of work into the analytics and research around how we can get ahead of, the resilience factor and also mitigating those issues. But on the second point, if there isn't anything to insure, property insurance and the nat cat, especially for Munich Re, is definitely our bread and butter and the lifeblood of our company, then we're in with a major problem too. I think that there's always, in insurance anywhere, it's always, the customer's always losing, but I think as an industry we need to educate the general public and all stakeholders that, it's not an easy game. There's the perception that for a long time, because of these soft markets and a surplus of capital which has been provided by these capital markets for a while now, with low interest rates, they're wanting to park capital somewhere and make a return on it. And surprisingly, last year you would have thought that money would have retreated, because remember, a lot of that's pension money, right? It's retirement money from all these large pension funds, which essentially is retail money. And if you're going into a game like ours, with hedge funds or investment banks advising you on cat risk, it's a bit of a problem in my opinion. Instead of pulling out, they've actually doubled down, and the reason there is that they're thinking, well, what's the likelihood of that occurring again? Where else can we put our money? to earn an acceptable result for our investors. So if that were to occur again, and there's no reason it can't with the the way this world is going in terms of climate change, then I think we're in with the perfect storm scenario where that excess capacity will retreat really, really quickly. The core reinsurers that know what they're doing and have been here for 100+ years and have the right models and have years and years of data will be the only ones there. But the end loser will be the end customer, essentially. And those price increases could be, unaffordable. In a lot of regions of Australia, it's already prohibitive, isn't it? So North Queensland comes to mind. So I think unless we do something around the resilience properly and get ahead of this archaic and legacy way of really transferring this risk, then I think that there's some dire times ahead of us, for sure.
So does anyone else have any thoughts on that?
Yeah, it's interesting. It's increasingly becoming clear to insurers that they've got to get behind adaptation as the way forward, because their market essentially, when the risk becomes so high, driven by climate change over time, and people can't afford to pay for the insurance, or it's just not insurable because it's going to be flooding every month, that they're going to lose a market. It'll no longer exist. And I think this is a couple of things to say about insurance is that it's not going to solve. It's not an alternative for adaptation. And I think people have to fundamentally get the point that insurers, they take the premium, but they give it back. They earn a little cut for the bad times, but they're not taking the risk away. They're just spreading the cost. And so the problem we have with climate change is that it's a systemic risk. It's increasing losses over time, and they have to go somewhere. So ultimately, Joel's right. It's we're going to have to pay as customers for the risk. Now, what becomes interesting, and this is a constant question in this forum, and it should be, because there's no simple answers, there are silver bullets, but it's how do we fund that? How do we pay for that? And how do we get the money to do the adaptation that we're going to need to do to get through climate change? I'm increasingly arguing to the insurance industry as my clients is that they have skin in the game and they should pay for the adaptation. Otherwise, they will lose markets. And it's not a popular opinion because everyone wants the government to pay. And the reality of that's another whole different dimension. But the reality is what we're facing is that insurance, like I'll say again, insurance is not the solution. It's how can insurers act to protect their markets? How can they work in collaboration with government, communities, and agencies and other entities to do adaptation so that we continue to have the highly needed resilience tool of insurance to smooth our risk over time and costs over time. And that, I think, is the challenge for us as an industry. Nope.
I think I'm just going to make a quick point, just sort of following on from what you guys are saying about, complex and uncertain risk. And even if we leave climate change out for a second, I think the one thing that I was a little unsure about in your original opening slides is that you used the word unforeseen circumstances. And we don't insure something that has a totally unforeseen circumstance. I'm from Sydney. I'm not going to pay for cyclone risk because why would I? So I think the thing that is, and then then you bring in the climate change risk, and that is the sort of crux of the issue, is that then it does become unforeseen because we can't look at the past to understand what sort of insurance we're going to need. For the cyclone example, I doubt they're going to get to Sydney, but we are talking about a potential moving south, and I think that's a complicated issue.
Yeah. Now, I want to stick with the themes, guys. And I don't want to go too quickly. So I still want to play around with this whole risk to insurance as a mechanism and the insurance industry itself. I mean, it's my fault. I concentrate on physical direct risk. What about other forms of insurance? Are there other forms of insurance or cover that, in a in a climate change world are becoming just more and more difficult to cover. I mean, have you got any sort of thoughts around that?
Yeah, I think it's inevitable. You've probably all been to Sarah Barker's seminar, and she would have talked about this for sure. But I think following on from the property damage or first party stuff is all these liability classes. So, you've obviously got a very litigious society and environment in Australia particularly. So if you couple that with our nat cat exposure, you've then got to think, well, what about the advice that the government's giving to, people building houses or renting houses or building businesses or building infrastructure? If something goes wrong there, is there a liability issue? Then you've got, the whole host of fiduciary duties for directors and officers as well. And following on from that, not getting too complex, but there's also that issue around trying to comply too hard and what compliance means around disclosure to investors and other stakeholders, and what's termed greenwashing. So are we actually compliant? And is that going to allow us to attract more capital and new investment, etc., because we say we are? And what if they actually aren't? And I think that's a major issue for a lot of companies out there right now.
Sarah and I were at a conference with atmospheric scientists, and we were talking about how we can use the science better to inform insurers and build models. And we started to talk about disclosure standards, the TCFDs you would have heard earlier. And I tried to crack a joke and said, these TCFDs are really great, and actually, sorry scientists, it's actually going to be the accountants who are going to change the world by doing all this. And Sarah Barker turned and looked at me and smiled and said, actually, it's the lawyers. and I think that's absolutely right. That the first losses to insurers from climate change is going to be liability claims. They're going to be directors and officers being sued. They're going to be the energy companies being held to account through the US courts for the climate change and damage they caused. That's the most. And forget about climate change happening in 50 years or that sort of stuff. It's happening today. Those actions are in the courts, and that's where insurers will be hit first. And it's a bit of an issue as well. There's a bit of a moral hazard issue around that. Is if you're protecting directors and officers too much, then they're not going to do what we want them to do through the TCFD and all that stuff. So there's some complicated issues in there. But yes, I mean, that's a sort of liability risk that we talk about for insurers. There is another part where transition risk, the whole transition we're going through, is also going to affect insurers, because the insurance follows the economics. If you've got an asset or something that's making money, you want to protect it and you buy insurance. So that's the concept. So as our economy changes, as we start to have more renewable energy, the obvious thing, and less coal power stations, insurers have to learn how to insure that. And just because you know how to show, the real challenge with the industry at the moment is that it's not an industry that's necessarily innovative. I mean, there are exceptions within Lloyd's, especially, where there's very specialist underwriters. But to insure a wind power station, a wind power farm, you've got to have some real experts in what are they called, dynamos and turbines and those types of things, which is very different to what you have in a coal power station. And so one of the big challenges right now is how do insurers develop that capacity and capability and change. So that's going to have an economic impact on them, because the other thing about it is that a lot of these newer industries and technologies are actually so much safer than the old ones. So, your car won't necessarily, well, I don't want to say this. I was going to say your car's not going to blow up so much if it's got a battery rather than fuel, but that's probably not true, so I won't say that. It's a good test to apply to what I'm about to say. But for example, a wind power station is going to be less dangerous for workers on than, say, working in a coal power station. So there's a whole de-risking, and as the risk moves away, that's also a loss in market for insurers. So it's a grim time to be an insurer. Because as all this happens, at the same time we've got autonomous vehicles happening, and so we're no longer selling motor insurance to people, and that's happening in the same kind of timescale as these climate change impacts are happening. If anybody has any jobs outside insurance,
Oh, it's not all doom and
I know.
Working with government clients, it's really quite a different world. The level of sophistication is quite variable, and the level of risk maturity across organisations is incredibly variable as well. So, just from a Victorian perspective, the big departments in the state context are quite sophisticated. They have risk management, they have a whole range of researchers, statistics, etc. at their fingertips. Our critical challenge is for those smaller agencies who don't have access to those resources, and how we actually have those conversations with them about risk transfer, non-insurable risk, etc. For them, it's very challenging to understand and make sense of.
And you can't walk away from your risks, right? Like, we can decide, and the insurers can decide that we can't take this risk on, but as a government, you have to keep it active.
It is what it is. But the good thing about being a government insurer is that you have a long, ongoing relationship with your clients. So you can develop things like incentives for organisations to actually think about adaptation, what they're going to do in the future. We are currently trialling different incentivisation models and activities so that some of our clients get on board with what we know reduces risk, and they will get a refund at the end of the year when they have demonstrated they have put into place those risk amelioration activities.
Sorry, can you provide an example?
I'll provide you with one in the health sector because that's quite tangible and easy. Maternity and babies being injured during birth is one of our biggest areas of exposure, especially babies with cerebral palsy. Claims for that go into the millions for lifelong damage and support. We have put into place a program where all obstetricians and midwives must have fetal surveillance, monitoring credentials and scope of practice, and must be up to date. If hospitals can ensure and demonstrate that the majority, we're I think thinking of 90% plus, of all clinicians working in a maternity area have got those credentials and are up to date, we will give them a refund at the end of the year, and we will audit that accordingly. So that's just a really good small example, quite challenging to set up, but we're moving into looking at other areas for incentivising.
Yeah, it was John who asked that question, wasn't it? Was it John? No? Oh.
Sorry.
Now, Ian, set a bad precedent. Couple of questions later. It's all right, mate. It's all right. Just moving on with this theme, I mean, I guess we bounce around a bit. This discussion's going to do that. It's my job to try and keep some of the logical steps, and I'll try and do that. We'll see. So we've established that there is a risk to the insurance industry from climate change. And I think, talking about Munich Re, Lloyd's, Swiss Re, they've been all over climate change since the 1970s, famously so. What is the industry doing about it at this particular point in time, if anything? It's a blunt question, but I'd just be really interested to get your thoughts on that.
Actually, that's probably a good one for you to start. Want me to go next?
I mean, there's a whole lot of initiatives, and I probably do the whole group and the industry a disservice by just speaking about the ones I'll speak about. But globally, we do a lot. So we've got a massive, a very well resourced corporate responsibility department in Munich, in head office. Part of our chief economist department. We've also got a foundation which does, that's a charitable foundation, doing a lot of work with micronations throughout the world. So doing a lot of disaster planning, resilience work, studies like that. But obviously, we've got massive research divisions as well, and that will include geoscientists, all type of, a lot smarter people than me who look at the way the world's moving and changing, and weather patterns and pollution levels, sea rise levels, etc. And that'll influence our models as well. At a local level, we're part of what's known as the Australian Business Roundtable. So that's 6 major organisations within Australia. If I don't get them right, Ian, can you jump in? The Red Cross, Optus, Investor, Westpac, ourselves and IAG. That's the 6-member panel. So a lot of that's around research and around disaster resilience, how we can look to help different regions within Australia plan for disasters, particularly around natural disasters, flooding, sea level rises, etc., bushfire, etc., etc. And that might have a lot of influence for us personally as a company, but certainly around that whole cost and affordability issue, that certainly has a lot of influence for communities and local governments too, who are grappling with that issue. On a more innovative product front, we do a lot of work in that too. So we've worked on a derivative product called OneStorm, which is basically, it's a parametric type cover that tracks, it's got a couple of triggers, but tracks a cyclone in various sort of categories, and if it fits within a diameter around an asset that is insured, there's basically a matrix that says there's an automatic payout once it reaches that sort of diameter around the asset.
Could you potentially just elaborate on what parametric?
Yeah, so basically a parametric in its most simplest form is there's a lack of, there's no loss adjustment or claims process. It's basically there's a trigger and there's an automatic payout. That's in its simplest form. Obviously behind the scenes there's a bit more to that around how the cheque gets cut and the funds gets transferred, but it cuts out all that layer around loss adjustment basically. And the idea there is that we thought, well, it's very unfair for all these business owners that they might do all the work around sandbagging, around boarding up, around all types of other mitigation if there's a storm coming. But then the storm might deviate at the last minute and they've actually suffered no property damage, but then they've expensed all that money and time and resources off their own balance sheet and profit and loss to actually mitigate for not only themselves but us to try and reduce harm. So the idea behind this is if that is to occur, just say the cyclone hits, fine, their normal property insurance will cover that. But if the cyclone deviates at the last minute and they've still, spent $1 million of their own money, and it fits these triggers, it'll actually pay those funds, which is huge. Particularly for small businesses and other type of businesses looking to, save as much as they can. And for a lot of businesses, that's a massive expenditure, and quite NatCat-prone regions can cause a lot of problems multiple times a year. Other things I talked about were the mine rehabilitation. So we've noticed that Australia's gone through that massive bust on the mining industry. What that's created is, I think at last count there's about 50,000 abandoned mines around the country, which is quite incredible, isn't it? And a lot of those need to be rehabilitated, but the governments don't have adequate funding to be able to do that. So what we've tried to do is partner with other private sector contractors and also consortiums to essentially create a new industry in that space. So to rehabilitate mines, whether it be coal mines, old gold mines, whatever it might be. The idea there is that we can come in and provide some type of cost overrun cover. So if there's an unforeseen overrun in the project that hasn't been budgeted for, then we will actually provide that cover. And the benefit of that is that governments aren't going to hand over that type of project if they have reputational risk attached to it. And the cost overrun and over budgeted blowout is obviously a massive reputational issue. So we've tried to put together solutions like that. That's only two. Like I say, there's many more that we've been working on. But we are, I know there is that stigma that we aren't innovative, but we do our bit, and we're trying to do as much as we can to not only do things in a legacy way, which again, don't get beyond that because digitalisation is going to take over in that respect too. But trying to do things in a more mitigating fashion, just not just around the reactionary process.
Yeah, so there are a lot of risks, and I've gone on about them, but there's definitely a lot of opportunities for insurers, and Joel's talked very well about the kinds of things that Munich Re is doing. Suncorp, there's John Harwood in the audience, hi John, from Suncorp, and Suncorp have designed a product where, so for example, for strata buildings in northern Queensland, if you have a claim for whatever reason, the policy will also put in some money to do some adaptation to your building, so putting in shutters, screwing down the roofs, so that you've got repair people there already. Let's get some adaptation done, let's build it better. That's, I think, a really interesting types of innovation, because that's one of the problems about insurance as a business is that you have to have scale, you have to cover the whole population, you have to cover large numbers, but you can't go and look at every single risk. You can't look at everybody's car, you can't do a driver assessment of each person, how risky a driver are they. You just have to do it in big categories. And that's what makes adaptation difficult sometimes, because having to go and look at each person's adaptation project to reprice it, you've probably spent as much money as you're going to save on the cost just doing the assessment. And so it becomes uneconomic. So the trick for insurers is finding how they can sort of sneak adaptation in. And that's the Suncorp one is a really good product. There are other innovations that are happening. So Suncorp is lending people money to do hurricane resilience measures on their house. If you're a bank customer and an insurance customer, they'll lend you money to tie down your roofs, to do whatever you need to do for those projects, right? So that's a really good win because the customer's getting adaptation finance. They're getting to look after their really important asset. The insurer or the financial service provider is getting to lend money, so they're getting to sell products and they can earn money out of it. But then they're also reducing the risk for everyone. So it's looking for those pockets of shared value of where everybody benefits that can work. And there are other products like that. So, for example, just taking the Suncorp one to another level. So, I think you're all familiar with the Coolroy event, where the houses fell into the sea after the East Coast Low. Now, there's lots of stories around that, but one of the stories is that there was actually permission to build a seawall, but we were fighting about who's going to pay for it. Now, if you were the bank that had lent money on those properties, or you were an insurer of those properties, perhaps you could have stepped in and given them a 10-year loan to cover the wall, split between 10 houses that they're paying $100 cost a year. Suddenly it's affordable. Suddenly you're reducing the risk on the properties that you have a financial interest in. So I think it's going to be projects like that. And I think the insurers who find those opportunities and work well with those opportunities and allow the funding of adaptation through reducing the premiums that people have to pay in the future or giving them access to finance directly, that's going to be a very big part of the market. And I think that's where the adaptation space and the insurance space are going to start to collide very strongly going forward.
Actually, I've got a question for Gabby.
Oh, good, okay.
Okay. I don't think I'm okay. So, I mean, what we're talking about is innovation and bringing parties together. And one of the interesting aspects of insurance is, and correct me if I'm wrong, it can be reactive, so it pays post an event, or can be proactive and mitigates the risk prior to an event. And there's some amazing innovation that's being spoken about at the moment. It's really interesting. But Gabby, from a government perspective in Victoria, are you seeing this innovation? Is at this particular point in time, what implications does that have for your clients, for example? Being a risk manager holistically, and what's happening on the ground?
We often play, I suppose, the linking role between the business and the boards of the business, which is an interesting one for them to actually also have, some input into enterprise risk as well, and an understanding of their own organisations and innovation. So it's pretty interesting. Often there's a divide between innovation in the business and actually knowledge and its reflection in board land and discussion. Where there are innovations, that really drives up an organisation's risk maturity, which means that there's the potential for negotiation on premium and deductibles, if that makes sense. So where departments and authorities are more innovative and can demonstrate adaptability and particular risk management strategies, that's where things get interesting from a state perspective, because we can then negotiate those premiums and change the level of deductibles for organisations as well.
Yeah. And
Unless your comment is directly relating to that.
No, it was going to be directed at you. So.
Okay, great. Cool. Just sort of back to the very sort of original question that you're saying, what are insurance companies doing, I suppose? And I'll say that obviously I only have a perspective of our clients, which isn't going to be all insurance companies, and I know we've already heard from Mark this morning about what IAG is doing. But I just think it's, I'd also like to have, this is quite optimistic, I think, what we're saying, but I think what we also need to understand is that insurance companies fundamentally have a good understanding of physical risk. And we look at climate risk and we go, that is divided into physical risk and transition risk. And because of the nature of insurance, we already have to have a good understanding of physical risk. What we don't understand is how that is going to change. So I think that we all need to sort of remember that we're at a good place to start. There are a lot of other corporate sectors which don't even have that understanding. And that's because of sort of hazard modelling and because of the claims data we have and that situation. I also a very sort of specific comment is about the Polaroid example. It's very close to my heart. It's where I grew up. And it's a really interesting one because you can't just build a seawall in front of those buildings because it will erode the beach. And if anyone knows the Northern Beaches in Sydney, it's that's where they get a lot of their tourism from. And also those buildings, we've known for 30 years that this is going to happen. And this whole idea of foreseeable, unforeseeable risk. And something that Saranjit, you've talked about a lot, I think at the Actuaries Institute, is fairness. Who should pay for it, and also who should, suffer? Should it be that these people who buy these beautiful homes on the beach, then, have the sort of environment around them, destroyed to protect their homes? And also, what we've been doing for the last 30 years is beach nourishment. So we've been moving sand from one end of the beach to the other end of the beach, which is costing taxpayers, not just those people, the whole Northern Beaches, money. So what is, I don't know an answer. I think it's a really complicated situation.
Actually, I'm going to be a little bit unconventional here, and because you've raised some really, really interesting points, I think, Kate, around fairness, equity, who owns the problem. I'm actually going to ask the audience. If there's any local government representatives out there, for example, is there anyone out there? Has anyone got any thoughts on this?
Can we?
I happen to be involved, or have been involved in the Collaroy Narrabeen issue for about 50 years, and it does actually date back 100 years. But the thing about I think it's key to all of this is that it wasn't really until 2011 that the insurance industry started to bring out flood insurance, and that was brought on, we all know, by what occurred in Queensland in particular. We still aren't seeing very many products in terms of beach erosion, and we're certainly not seeing any products about beach recession. So erosion, I'm differentiating between erosion being on and off, and recession being the long-term trend, which is the sort of thing that we'll see with climate change. And what I'm just wondering with all of this is, because something like Collaroy Narrabeen is almost impossible for local government to deal with, for a number of reasons, but it would be much easier to deal with it if there were in place vehicles, insurance vehicles, that gave good signals to the market, so that these houses didn't just keep on going up in value, and you didn't keep on getting people putting places in silly places. And I'm just interested in where the insurance industry is at with recession and erosion type vehicles as against the flooding. I see this as just sort of the next step from the flooding. And really, local government needs that desperately.
A slightly sort of pessimistic response, but from my experience, I think even just modelling storm surges is not where modelling flood is, and that is a sort of prohibitor to, I guess, those kind of innovative products being developed.
I'd say an interesting concept in this regard is also different vehicles and structures as well, like rehabilitation bonds, which are being used in the mining industry and other areas as well. I think that not enough of that is being utilised, and I think that it's probably very small-minded in terms of this issue. I mean, I'm not a coastal erosion expert at all, but there seems to me, just thinking about it, that there's perhaps an opportunity there in that regard too.
Yeah, this is a very important and vexed question. I think there's a few things here. Flood insurance, yes, it's now insurers offer that, but a lot of them offered it before they were required to. But the insurers offering it doesn't necessarily mean people are buying it. And I have a view, and I don't know, we haven't seen all the data for this yet, that yes, some people now have access to flood cover, but if they have a really significant flood risk, that cost could be prohibitive. I don't actually know if at a net level people are actually more covered for flood than they were before it was compulsory for insurers to offer the cover. So I think what happens is, and this is what I'm sort of talking about risk transfer, it doesn't take away the risk. You still have to pay for it, you're just paying for it in advance. And what we really need is solutions around retreat or solutions around adaptation for that issue. Insurance is not really going to cover it from that point of view. I think there's another point you raised there, and this is all the ways insurance can help, and price signalling is very important, because what insurers do is really, really hard. I mean, Kate's a really good expert at this, and I work with lots of people expertly. I don't hold any expertise in myself, but actually calculating that risk is really hard, and converting risk into a single financial number, it's so routine, but it's really, really hard to do. And when we don't have data and information, it's impossible, and insurers can't function under that basis. But what we can do is signal and say, this is a high risk, and your premiums are going to carry on increasing as your risks increase, and therefore that's a kind of stick way of saying you need to do adaptation, right? And it's important we do that. It's also really important that I'll just say this, although it'll make no difference, that we find mechanisms whereby local councils can do better planning and push back on development in flood zones. And we get building standards improved over time as well, so that they're actually looking at the types of risks we're facing in the future. And so it's not going to be just the insurance to solve the problem. And in particular, I think one of the things that we will see going forward is when you buy a house, how many people check what it's going to cost to insure the house before they buy it? I don't. I'm an actuary, right? And the biggest insurance geek there is, right? But I don't even do that. I will going forward, and I think that, and that's the problem, because it doesn't matter if we signal the risk if no one actually is looking at us until it's too late. But I think going forward, banks who lend on properties are going to be playing this a lot more, and sort of saying, well, actually, what's the coastal risk here? Because again, you didn't want to be the bank that's got the property falling into the sea, because they're not going to carry on paying their home loan when there's no home. So I think banks, and we're seeing that already, are stepping up. So you can expect in a few years, I'll expect that bank will actually do a climate risk assessment on your property before they lend you money on it, because they're lending you money for 30 years. We will see climate change impacts for 30 years. And that's really interesting, because I think leading this space in the financial services industry are the banks, because they write 30-year policies. Insurers are actually falling behind in some ways, or have less of an incentive, let's put it that way, because we're just looking at 12 months at a time. We're incredibly short-minded. The whole organisation of insurers and the way management are rewarded and assessed and managed can be just about what we write, premiums we write, and claims we have over the 12 months. No one's thinking about claims in 5-10 years, or very few people are, but that's growing. And it's those types of adaptation that insurers have to do, and banks have to do, and financial advisors have to do, and governments have to do as risk holders.
I'd like to explore that a little bit further, if I may. We certainly have the annual premium cycle, but we also have life insurance, which is, of course, a much more, and this often gets forgotten about in the climate change insurance discussion, which has much longer dated instruments, which are essentially grounded upon long dated investments that are made to meet those insurance claims whenever they happen to fall due. Is the insurance industry, with climate change and the more medium to longer term risk, it certainly is here right now, but it's increasing as we go forward, of course. Are you aware, is the insurance industry taking that into consideration? So in other words, I guess I'm asking from a life insurance perspective, but also from an asset perspective, because the insurance industry manages a huge number. I think it's definitely in the trillions globally. I have assets under management. What are your thoughts on that? That's all right.
if you've got any thoughts.
Well, I think life's an interesting analogy to the long-term issue as well. In that you're right, the correlation between investment income and the risk and what's going to happen over a period, and emerging risks like white-collar type mental health, which is happening in the life insurance industry, which is pretty much akin to climate change, right? In that it's this new unforeseen sort of risk we knew about that was there, but now it's sort of gone bang. And what mental health's done to the life insurance industry is just it's horrendous. In many ways, that's a very strong similarity to what climate change is doing to the general insurance industry as well. I think on the asset stuff, you'll see insurers starting to really kick into gear now and not only exit out of stranded asset or pollution-causing assets like coal, but they'll also start to pull out of insuring those assets. And we were talking before, Ian, I think it was you and I, about that knee-jerk reaction is a problem in itself, because you then that flow-on effect to industry in general means that you've got a whole workforce and communities of people that then have livelihoods on the line. So the impact and flow-on from these sort of reactions by insurers and banks is massive. So I think there has to be that transition and a really patient but educated transition around doing that.
Yeah, there's a lot to be done. I agree with that. But on the specific question, so we talked about that unforeseen risk sort of thing, and I think it's interesting. I think there's can you do a product that says, for example, in these coastal erosion, we know this house ultimately is going to end up in the water, but we don't know exactly when. So it's the same as we know someone's going to die, but we don't know when, and we provide insurance over that time frame. And what really we're doing is it's actually a savings type product. So people pay money so that they essentially save money. So when their house is no longer usable, they can use that to buy another house somewhere else. So that kind of financing of retreat and using insurance as a mechanism to do that, it's not taking away the risk. You're still paying for what you get, but it's essentially spreading the cost. It's financing the cost. I think that's an interesting innovation, and no one's doing it yet. The other area on the topic is one of the problems as well. I think we have is that when insurers give indemnity type contracts, which is essentially saying we'll put you back in the position you were before. So if your house floods, we'll restore it to how it was before the flood. We should be doing better than that. We should be saying we'll build it back so it doesn't flood more. Right? So at the moment, because there's so much pressure for insurers to get people back in their house, to pay the claim, to rebuild it, there's no time for any of that. And we might need to think about innovative products like when you buy your home insurance, your buildings cover, what you do is you get to choose the house they're going to rebuild for you. So you go into the shop and you say, right, I like one with 3 bedrooms, and it's going to cost me this much to have that one built instead of the one I've got. You can choose your favourite Caesar stone for the kitchen, you can choose the paint colour. And the insurers get really good, they give you a selection of, say, five of these, right? And they get really good at making these houses quickly and fast. So, you get them all flat packed in the warehouse somewhere. And so you can just, have them all on the spot straight away afterwards. And they're all designed so that they are they have inbuilt adaptation on them, right? So that they're less likely to fall down into a house. That's a mechanism we're not really using in a big way at the moment to do adaptation. And it goes with business as well, and it goes with all sorts of industries. And as government insurance, you have that option. And I think we should start thinking like that. Insurance should start making those types of products available so people can pay extra to get adaptation built in.
I guess the question on that is with the short-term mindset of the population is, are they going to pay that extra? I mean, that's the problem, isn't it? There has to be some type of not going so far as third line forcing, but some type of pressure or incentive to make them choose that option, because it sounds great and I agree with you. I mean, it sounds like a good option, but are people really going to pay that extra money? I'm not sure.
Yeah. Can I just have a word? Because we're actually running out of time. That's my fault, because I've been geeking out on this discussion. But there's one thing I really wanted to cover, and that's actually around collaboration opportunities. So a lot of it that's been discussed at the moment really is, and correct me if I'm wrong, is insurance can be a powerful mechanism, but not on its own. There you go.
That's all right.
So what? And I'm going to pose this to you, Katie, and then Gabby. I'd like to get your thoughts because you're sort of getting bookended here between these two blokes. They've got a lot to say, and rightly so. Don't get me wrong. But collaboration opportunities between the banks, between the insurance industry, right across the financial industry, across government. You know, what do you see that's out there, and what are the burning issues that need to be collaborated on?
I think actually two terms I've heard a lot at this conference so far is, probably one is knowledge brokers, and that's particularly interesting for me as working for a brokerage. And it's also, and so I think that's really interesting, and it's particularly I think between the scientific community and between, for example, insurance, but also other private industry. Something I have heard a bit about before is data brokers, and this is something that I also think is really important because we sort of, at the moment, are in this situation where there is a lot of data out there, but who knows how to use it, who knows how to access it, who can access it. And the problem with, as I'm sure you guys all know, the problem with, I guess, private industry is that you can't just release all your data because then you lose your competitive advantage. And I think that this is sort of, I guess maybe came up a little bit in the questions after Mark's talk about releasing the claims data. And that's something that, is very useful, but huge privacy laws that. Also, the last question about life insurance, big issues if you want to look at the relationship between climate change and health, because you can't release people's medical records. So I think that the data sharing is important, and I think especially from the government data sets, from research institutes, then we need to find a way of, I guess, closing that gap.
Whereas the MIA are in a very lucky position. We would see teams like mine, that's an insights team in the organisation. We bring together data sets. We're very lucky that we can access data sets from the rest of governments, Bureau of Statistics, etc., and combine that with our claims knowledge. That provides very powerful feedback to our clients about how they're travelling, but we also benchmark that across different industry groups and types. So individual clients can actually see how they are performing, and we take a risk-based approach so that we do more proactive interventions with those who are performing poorly across the state. So very lucky that a lot of our clients will share their data and information with us, and we build a lot of overlays, whether it's in geospatial world, looking at assets over floodplains, bushfire areas, at sea rise, and modelling around that, but also on a whole range of issues that actually help manage that risk. That's very powerful.
Now, listen, I promised you all 20 minutes, and I think we're down to 18. Are there any questions from the floor? This lady.
Thank you. Nina Rogers from the Tasmanian Department of Premier Cabinet, working with Tasmania's 29 councils on how they embed understanding climate risk in their decision-making processes. My question is, particularly for the captive insurance, what role you see for yourself in building the climate literacy of council executives or state government executives, as the case may be, and elected representatives, so that they have a good grasp of how they can be enhancing their resilience to climate risk, and in turn how that might reduce claims, be that for liability claims or natural catastrophe damage.
We have a very lucky situation, I think, in Victoria, that we play a real education and training role, especially at board level and at executive level, around issues. Because climate change is such a huge issue and a real worry and concern at local government and at that interface with state government and federal government, there's a large appetite for doing a lot of work with them, and whole of government work as well, where many departments are impacted at the same time at those interfaces between, for example, environment and health, or education and health, or all three of them coming together. So there's a lot of opportunities for us. We have a large stable of risk advisors who go out with our insurance team and do a lot of work in that space, in education training, and also in risk management and understanding how this links to enterprise and strategy for organisations in government.
Hi there. Thanks for all the information. It's been really interesting so far. My question, I think Sharonjit started to touch on it, but it'd be great if you go into more detail, or anyone else on the panel. But I'm interested in, given the great concern that climate change is to the insurance industry and the large amount of skin that they have in the game, what role the sector should play in risk mitigation. And I'm probably more interested, rather than the individual kind of household level examples that have been discussed, more things like larger ecosystem preservation, whether it's reefs or wetlands or things like that.
So I think there's it's interesting because there's talk out there about insuring reefs and things like that, and when you look at it, it's not actually doing what it says on the tin. There's a lot of skepticism within some of the industry, but also fundamentally there are some things that money is not a substitute for, right? It doesn't matter, if we lose the last bit of reef, it doesn't matter how much money we get from it. It's the last bit of reef's gone, and I think that's another thing to understand about the limits of insurance. Insurance gives you financial compensation, but it does not give. Some things are not losable. So there's a danger if insurers start doing that we're not solving the actual problem, right? There are roles insurance are playing in mitigation. Allianz, for example, the global insurer, has announced that it won't insure any fossil fuels anymore, businesses anymore. Well, they haven't done that. They've actually said we'll stop doing it by 2040 or something. which, by the way, we all know that's all going to go anyway by that time. But it's interesting signalling, right? So insurers do need to step up their game. They need to understand, and that's part of the work I do with them, is that this short-termism about supporting industries that are doing greenhouse gas emissions is not in your interest. It is shooting your foot. It is destroying your long-term business, and you need to let it go and be part of the action that we're doing for mitigation. But it's a hard money in your hand today versus some strange scientific green left-wing stuff out there. It's a tough conversation.
Can I just clarify, my point about the reef was the other way around, about actually insurance industry itself investing in reef preservation to protect their insured assets on land.
We're seeing that, and we're seeing insurers, QBE, for instance, has a large investment program in different things. XL Catlin, an insurer out there, they've been doing a project whereby they've been making 3D films available to scientists all around the world on every reef, and they've been going out and doing that video and sending it around for research purposes, and they've been funding that program. So we are seeing those types of things happen, and the smart insurers are getting on board. My view is that those are sort of reputational gains, and I think we get real change when it's financial issues. When you start to put things in terms of, this is not just about you being a nice corporate citizen, they want to do that, but let's frame arguments in terms of, this is you making money for your shareholders. Those arguments work a lot more, and so I try to use those a lot more. Yeah.
I'll just add to that. There's also the argument that there's a lot of insurers and reinsurers doing a lot of that good work already. And in many respects, as an end customer, the end customer needs to take responsibility in the whole supply chain as well, because that motivation to keep investing in that knowledge share and that preservation will slowly dwindle. What's the point of a group of us doing all this work, investing in this money, where a hedge fund puts in billions of dollars to take our market share on large cap programs where clients only want the cheapest premium, right? So there has to be that balance as well with the end customer and the whole supply chain, that there has to be some type of recognition of the goodwill that, and I'm not just talking about us, there's a whole lot of insurers and reinsurers doing that work that needs to be recognised as well. Obviously we have a role, but I think the whole supply chain does as well.
G'day, my name's Donovan Burton. I'm an adaptation specialist for climate planning. So I'm fascinated with disruptive technology and disruptive systems. So you think of the Airbnbs upsetting the tourism industry or the hotel chains, and the taxi chains getting affected by Uber and the like. Now, what happens if a disruptive entity, because it's reasonably untapped at the moment, comes into the insurance market and it takes away some of your most profitable part? You touched on it in terms of the cat bonds and the nat cat stuff. Is there a risk there for the insurance industry from that disruptive space, especially with the Internet of Things and the emerging new risks? Are you aware of the industry thinking about that in this space?
Well, I think, Don, interestingly, as a real chalk and cheese, yesterday in Sydney I was on an InsurTech panel actually judging a prize for best innovation. So I think the industry as a whole recognises that digital disruption is going to happen. It's inevitable. And I will unequivocally say to everyone in the audience that if we don't adapt in that space, then we will die. I think that being so big for so long, you can probably cop a few punches for so long and you'll still stand up, but eventually it will knock you down. So I think that the smart ones are certainly embracing it. Us individually, I think we, at last count, invest about €100 million every year to our VC fund to invest in digital and innovation. So you're 100% right. I think any way that the industry, which is very archaic, self-admitted, can change and embrace that digital technology is a positive thing. So yeah, you're right. Yeah.
I've got another interesting example, if I could quickly chip in. Insurance started back in the 1700s because a bunch of ship owners decided to share risk amongst themselves. And that's sort of when the mutual insurance idea came along, and then that eventually a corporation took over that risk and provided service. I think we're actually going to see something whereby when we get to the point where insurers can no longer insure an activity or do it at an affordable rate, that we'll actually see ourselves going back to that. So if you still want to live in an area with your neighbours which is uninsurable, maybe you could share the cost between the lot of you. So we're seeing technologies like blockchain being used to replace that, so that can become the trusted parties. I think we're going to see, ultimately, I hope we don't have to get down there, but when we get to the points where things become uninsurable, but people still need to do that, like live in a house, we might have to use technologies like that. And there are lots of players out there thinking about this and how to do that. And bringing insurance back to people in the way that Uber has brought transport back to individuals with cars, and that's going to happen.
I think there's a gentleman back. Working my way back.
Bruce Rhodes from Melbourne Water. My question is a fairly fundamental one. You're faced with projections of changing risk in a changing climate and variable climate. At what point and how do you decide that you'll no longer be part of a particular market in insurance? What's your triggers for exiting, and how do you communicate that?
It's a great question, and one that probably people don't understand in general society, I guess. But at the end of the day, if insurers aren't making money, then they don't have a premium pool to pay claims. And I think that it'll get to a point where if a class is that unprofitable that they are actually burning through money without a reasonable ability to be able to make that up in some time frame, then the decision will be made. I mean, you see other classes right now in Australia. Directors and officers is one. With the heightening or catastrophic class action environment, there's been a lot of insurers locally and abroad that have just simply if you're running at 300% or 400% combined operating ratio, you can never make that back in that class. And when it starts getting to those levels, I think that's the trigger.
Can I just add, sorry, quickly? I just think that's, I guess the suggestion then is that will that be reactionary? Will it be, after a particularly bad year, insurance companies will then decide to, not insure a particular area or whatnot? And I think you mentioned the climate projections, and I think this is why I think it will be reactionary, is because there is still there's obviously uncertainty in the science, which everyone keeps talking about, but there's also uncertainty in the mitigation, and we don't know which RCP pathway we're going to follow. So it's hard to, and these are obviously idealised ones, so we'll probably be somewhere in the middle, hopefully somewhere in the middle, not at the end. So, how do you, with foresight, choose when you stop insuring assets?
But I think the good point about that you make is that inevitably, which is not good for the end customer, is when it happens really quickly, and that's a disaster. Particularly like in regional areas with property insurance or things like that, is that the insurance industry does do things very quickly when things are going badly. So that's a risk for society, really.
Mark Lafastria from IAG. I just wanted to pick up on the question around insuring for beach road, coastal road and stuff like that. I'll just cast my mind back to early 2000s when there was pressure to put flood insurance product out there, and the market was sort of saying it's too costly for us to actually do all the flood modelling ourselves. We can't get the flood information from local councils, and so we won't produce the product. It goes back to one of your earlier slides around trying to, if it costs a lot or there's too much uncertainty in understanding the risk, then that loads up the price. So going to the coastal erosion thing, the biggest issue with that right now is it's not just insurance here, it's actually why isn't there a national data set now that should be feeding into planning decisions, which is available right now to communicate to property owners what is the risk in the first place. The last thing you want to do, I think, is a bank or an insurer be the first person to tell you you've got a problem. So if we were to try and do the coastal erosion mapping, I don't know how much it would cost, unfortunately. That would have to be loaded into products. And it's an essential community product here. It's something that should be informing our building codes, our land planning decisions, and that stuff should be readily accessible for everyone. One of the things when we've gone out looking like introducing flood cover, we have a third party who owns the data. And it might be a local council, it might be an engineering firm, and they're trying to sell that product on again. And I just have this problem. If it's something that's a fundamental data set for land planning decisions for building codes, it should be a community issue that should be freely accessible for everyone.
Can I just say I fully agree, and the hazard mapping I've been doing since the late 1970s has been fully available publicly, and nobody's picking up on it.
So maybe it's more where is it and how can we access it?
Yeah, can I ask, sorry, Kate, have you got any thoughts on that?
So I'm just going to mention from, I guess, the flood perspective. So Willis with Risk Frontiers, there's this thing called NFID, just a National Flood Information Data Set. And basically what it is it brings together all local flood studies, and I think some larger ones as well. And so that is then available to the IC Insurance Council Australia members, so it's not what Mark's suggesting, which is something that everyone can access. So I agree to an extent that people should be able to understand their flood risk, but I think, as you said, local council studies are available, but people aren't looking at them. Also, if you amalgamate everything, firstly, it's very difficult and time-consuming. I know because I do it. And also, there are very different qualities of flood studies, and it basically depends on how much money the council spends on it. You can either get, you can get flood engineers in that do an incredible job, and it takes 5 years, and great, and then that's a really valuable resource, and hopefully people use it. In other areas, you don't have the same amount of money, maybe because it's not particularly flood-prone area. I don't know. I'm sure there's a huge variety of reasons. But yeah, so there does need to be, I think, that discerning nature on I guess blood studies in general.
Listen, we've only got time for one more question. 3 minutes to go. It's got to be short and sweet. So, whoever asks the next question, no long statement.
James Doogie, working on adaptation for the Western Australian Government. Thanks, everyone. It's a great discussion. Really enjoyed it. For Gabby, on the collaboration theme, for various captive insurers, local government and states across jurisdictions in Australia, is there any level of collaboration currently, and whether there is or is not, what value might you see in that?
Yes, there is a collaboration. So I think VMIA seem to host a lot of national and international gatherings of captive insurers, and we also invite some commercial insurers as well to participate in forums, which are often topic-based. I don't think we've done one to date on climate change challenges for captives, so that would be a really interesting topic to do. But we do interact with all of our peers across Australia and New Zealand and internationally to some extent around topics of mutual interest and bring together them as a bit of a community of practice. At those sessions, there's a lot of showcasing of different initiatives and different activities that captives are doing. And it's always interesting that people are very envious of VMIA because we have that risk management line of practice compared to the other captives across Australia.
Okay, well, unfortunately, I think that's time's up. I'm not going to try and summarise any of this. There's too many what I will do is I'll thank the audience. Thank you for your questions. They were really very interesting. Thank you to the panel. Thank you, Kate, Joel, Sharanjit, and Gabby. And thanks again to the Victorian Government for the opportunity to explore an issue which is obviously on a lot of people's lips at the moment. I think is just going to come more and more under the radar as time progresses. So, without further ado, just enjoy your coffee and thank you very much. Maybe